trying to weigh the extreme negatives we're getting with, I guess you'd call them mild positives. On the negative side, everyone's bracing for whatever this claims number might be next week. Obvious distresses in credit, which we've talked about for days. On the positive side, you've got a fair amount of insider buying relative to sales. You've got to go back several years to find that kind of ratio. Better mitigation in California. The Senate now with a headline, this package may allow the Fed to buy muni debt. How are you balancing everything?
Well, you can't really balance everything, is the truth. We're going to have a very significant hit to the economy, and mitigation efforts are going to extend the length of time that hit is going to extend across the economy. What we're really looking at is what's going to happen after this is over and whether or not the government is going to provide the right kinds of support. And it looks like they're doing that. The Fed and all of the central banks have done an extraordinary job of rolling out all of the plans from 2008 and 2009. They've done that quickly, and in my mind, whether it's munis or in mortgages, they've done all the right things to create liquidity in the market and confidence that they're going to make sure that everything is right, including dollar funding, as you've talked about. On the other hand, we're going to take this very, very giant hit that's going to affect small businesses and individuals.
So how, I mean, you're trying to look through it. How efficient is the market at looking through it, given that we saw numbers coming out of China that really didn't derail our own equities until a lag of several weeks?
That's right. And so, my expectation, or Citi Private Bank's expectation, is that we're going to see actually worse numbers in Q2 than people are expecting. We're talking about, GDP down 15%. We're going to be talking about extraordinary unemployment or underemployment numbers that could, take our levels of 10% or even 15% of people who are furloughed. So it's going to look pretty awful for the second quarter. And the issue is, how do we recover? And that's where the government programs come in. So if what's in the new Republican bill that just got released is true, and there are small business loans and people can actually continue to get income for that 4-month period, then the impact in the economy is far, far less. And we get bridged across what will be a very short-term, extremely severe downturn. Once the markets see that, and it will take, I think, at least another 2 to 6 weeks for them to believe that that's going to happen, and then they have to get through the healthcare crisis, then you can imagine markets being more opportunistic. But between now and that time, we expect great volatility and quite a few relatively ugly pictures of what's actually happening in major cities in the U.S. as the full healthcare impact actually hits our screens on TV.
Yeah, David, you just touched on this, but I'm going to dig into it a little bit further, and that's the fact that the markets and the economy are two separate entities. Now, mind you, they're extremely intertwined, but given the pretty dramatic moves lower we've already seen within the markets over the past month, are there already opportunities for maybe perhaps long-term investors to be getting in here at these levels, even if we do see, at least in near term, further pain, further volatility as some of those economic numbers shake out?
It's an excellent question, and it's the hardest part of being a chief investment officer. So about a week ago, we wrote that if you were going to put money into the market, you kind of want to put a third of it in now. You can't be precise about when to enter the market, but valuations now are 30% down from where they were 5 weeks ago. We are advising our clients to put money into the highest quality stocks with the strongest balance sheets in industries that are clearly going to be less affected, whether it's software, cybersecurity, healthcare shares, a long list of things. We also think that banks ultimately will be a good place to be. They're going to lead us out, and even though there'll be a heavy hit, they were deeply impacted in the markets, they'll be attractive. So you begin to invest now, and then you invest more as you get more clarity. You just can't do it. And the second thing we're advising our clients to do is not to try to market time with their core portfolios. Again, if these scenarios play out, it'll take time for portfolios to recover. But if you try to market time with markets like this, with this volatility, you're guaranteed to lose. That's for sure.
When you say takes time, I mean, I've seen some desks coming out with a return to the S&P 3K over 5 years, the very long road to get back to levels that we saw just a matter of weeks ago. I want to ask you about that. And then, as we're speaking, the presumptive presidential candidate, Joe Biden, I'm calling on every CEO in America to publicly commit now to not buying back their company stock over the course of the next year. How much of a drag will there be on equity recovery, given some of the policies that might be enacted as a result of bailouts or rescues?
Right. So a variety of different questions there. I think, let me sort of go from the top, but when you think about the recovery, like if people say it'll take 5 years to get back to where we were, the truth is that we actually don't know that. The amount of stimulus that we're talking about giving this economy, if it turns out to be $1 trillion, I think will be far too small. But if it was $3 or $4 trillion, in other words, inflation adjusted for what happened in 2008, that would be significant. Interest rates coming out of this situation will be 1%, as you just heard what Peter was talking about. So low interest rates, an enormous amount of stimulus. If we bridge this correctly to the other side, the individuals will be hurt less than they're going to otherwise be hurt, and small businesses the same. You can imagine a very strong 2021 with a 13 to 15% a growth rate in earnings next year off of a very low number this year if that happens. So that's the optimistic view. In terms of what you were talking about in buybacks, that's a different story. That clearly takes some of the wind out of the markets because companies will be holding cash to stay safe, and buybacks have been a large driver of the markets for the last 2.5 years, 3 years.